Alright, so welcome back to another video on how to secure yourself financially, especially making a quick recap of this beginner guide to financial statements. So, the SEC, the Security and Exchange Commission, uh, where this is an agency that oversees the exchange of security in the US. The security is all of these uh, financial instrument that holds some monetary value that is fungible, meaning that it can be traded with another financial instrument of the same type, such as money, for example, is fungible. It has that ability. So security is this financial instrument that holds some monetary value, right? And the great thing of this is these financial instruments entitle is the owner to a part of the company, and they're usually called stocks, or to a principal and interest. They're usually called uh, bonds, right? So the great thing of this is these financial instruments allows to transfer wealth or capital in the most efficient way for most profitable business, right? For the most profitable uses. So understand that it's something crucial because, especially for wealthy people or people that wants to transfer their wealth or capital across border, for example. So doing through financial markets and using these financial instruments allows you to do that. So this is the flexibility that I as an individual am looking for, and that I will argue that anyone should strive to. But in any case, so that's what a security is. So reading about the by the inner guide to financial statements, you can read nutrition labels or baseball or soccer box scores. You can learn the basic of financial statement, and if you can follow a recipe or applying for a loan, which is time consuming, you can learn basic accounting, and the basics are not difficult. So this section will show us how to gain basic understanding on financial statement, much like CPA class teach you how to perform cardiopulmonary resuscitation. But looking at how to read this basic part of financial statement won't train you to be an accountant, much like a CPA course won't make you a cardio doctor. However, it can give you some confidence to be able to look at a set of financial statement, make sense of it. That's the reason why I'm doing this. So financial statement, after all, they show you the money, right? From Cuba Gooding Jr. Immortal Line from Jerry Maguire, and I don't know if you have saw that movie, and I didn't. I didn't. I would like to, but they scream, "Show me the money!" Right? So he screamed that. So that's what financial statements do. So they show you the money, where the company money came from, where it went, and what is it now. Okay? So for financial statements, we got here the balance sheets, income statement, cash flow, and statement of the shareholders. So the first balance sheet show you how much a company owns and what it owns at a fixed point in time. The income statement show you is how much money companies spend and make, again in a period of time. Cash flow show the exchange of money between that company and the outside world, and the statement of shareholders equity show you is the change in interest of the shareholders over a period of time. So let's going to look, or in this section from the sec.gov, we're going just to look at the first three financial statements: the balance sheet, which show you a more detailed information about the company assets, liabilities, and shareholders. And assets are things that a company owns that has value. Typically, they can be either to be sold or they can be used to make products and services that can be sold. So you have two types of assets: intangible assets, things that you cannot touch, such as trademarks and patents, and physical or tangible assets like inventory, land, equipment. Uh, Cash is another form of assets, and the amount of investment that a company made. Great. Then you have liability, which show how much money the company owns to others, and they refer to money owns to suppliers for material, for example. The borrow money from a bank to launch a product or service. Payroll, a company owns to its employers. The rent for use a building. Environmental cleanup costs. So, for example, the Ohio toxic leak out. Yeah, the Ohio train derailment. The Ohio train derailment urged Norfolk Southern to join close call reporting systems. Toxic waste from Ohio train disaster. Okay. And they call EPA for that. The environmental protection, the environmental EPA in the USA. EPA is the Environmental Protection Agency. Okay. We send that. Alright. Okay. Ohio train derailment. GB. Then Saints Biden out to show up. In any case, what is that? It's a toxic waste from Ohio train disaster. That was in February 2023. So, again, environmental cleanup costs. This toxic waste from the Ohio train disaster. Uh, and tax owed to the government. Okay. Also, anything or any good and service that a company has an obligation to provide in the future is also a liability. So, aka promise. So, if you make a promise, okay, about you're gonna provide a product or service, that's a liability to you, not only as a company but also as an individual. Okay. But in any case, then we have is the shareholders' equity, which is also called the net worth or the capital, and it shows how much money the shareholders will receive if all the company assets were liquidated and pay off all of its liability. Uh, so that money belongs to the shareholders and or the owners. So this balance sheet is organized in a formula like assets are equal to the uh, liabilities and shareholders. So sometimes you might have that layout where all of the company assets are listed on the left side and the liabilities and shareholders' equity on the right side, or you have all the assets on the top followed by the liabilities and the shareholders' equity. So generally the assets are listed based on how quickly they can be converted into cash. So you have current cash, non-current cash, I mean current assets and non-current assets. So current assets are things that the company expect to convert that within a year. For example, inventory and non-current assets are things that a company are not does not expect to sell, or it will take longer to do that. So in there you have fixed assets that allows the business to run, basically, and they are not for sale. For example, in my case, it's like my laptop, my keyboard and mouse, right? Even though I can dispose about from the keyboard and the mouse, but I cannot dispose of my laptop, right? Because that's what I use to make service to be sold, right? That's my as a consulting, as a business consulting freelancer, offering is this. Again, this might not be very scalable, but that's another challenge, and that's another video, my friend. But in any case, here uh, talking about is the how assets are generally listed. Then I look at liabilities. They're generally listed based on their due dates. You have current liabilities, obligations that a company expect to pay off within a year, and long term, due to more than a year. Uh, and the shareholders' equity is the amount of money owners invest in the company plus or minus the company earnings and or losses since inception. So sometimes company redistributes their earnings, and they call that dividends instead of retained. So the TLDR for balance sheet, when you look at that, okay, is this is a snapshot of the company assets, liabilities, and shareholders' equity at the end of a reporting period. So it doesn't show you the movement of money in and out of that. Then, right now, I'm looking at the okay, because things start to get more warm here. But right now I'm living is the summer. Okay, that's good. That's great as well. But anyways, so the income statement, which is the next financial statement, it showed you how much revenue a company made, and the associated cost with respect earning that revenue in a period of time. So you have quarterly or annually. At the bottom line of the statement, you have is the company net earnings or losses, right? So it shows you if a company actually made money or not. This statement also shows you the EPS, meaning the uh, UPS, exactly. So this show you is the EPS, the earning per share, and it's a calculation that if a company decide to give away all of their earnings to the shareholders, that's the amount they're gonna receive. In company almost never do that. Instead, they reinvest that in their business. So that makes sense because to understand how these income statements are set up, let's need to think of them as a set of stairs, right? You start at the top with all this total of money made from sales of product and service, and once you go down each step at a time, you make a deduction of certain costs, operating expense associated with those earnings. So at the top we have is the gross profit, where this is the total amount of money made from sales of product and service, and they call gross revenue because the deduction has not been, or expense has not been deducted from it yet. So they call gross because the number is unrefined. Moving down, you have things that a company does not expect, or money that a company does not expect to collect, such as sales discount or merchandise return. So once you subtract this return, this merchandise return, uh, and the allowance, and allowance is anything that a company expects to pay off to someone else, right? Uh, Once you subtract the returns, merchandise returns, and allowance from the gross revenue, we arrive at the company net revenue. Okay, and you can think of that as a net because the revenue are left in after deduction, or after deducting returns and an allowance, right? So they call that is the net worth, or the uh, net revenue. So we have here the company net revenue, right? So moving down the line, okay, sometimes there are several lines that represent various kind of operating expense, but most of the time, after the company net revenue, you'll find is the total cost of sale, or the cost of sales, which is the total amount of money that a company spends to produce products and service in that accounting period, right? So the next line, or the next section, deals with operating expense, the company expense, the company operating expense. Okay, so um, expense that allow the company to support their operations, such as salaries for the administrative personnel, research, or the cost of research for new products, marketing, and this is different, or these operating expense are different from the cost of sale because they cannot be linked directly to the production of good and service. However, they support the company operations. So to recap, we have at the top the gross revenue, then all the deductions or money that you don't expect to collect from sales discounts or returns. Then when you subtract the returns and allowance from the gross revenue, you arrive at the company net revenue. Okay. Moving down, then you have most of the time you have several lines that represents operating expense, but typically you have is the cost of sales. So the total amount of money uh, uh, that a company spend on products, the good and service in that accounting period, the cost of sales. So the next section, it shows the operating expense, anything that allow the company, or any expense that allow the company support their operations, such as salaries, okay, such as salaries, um, yeah, such as salary for administrative, uh, the cost for research, the cost of researching new products, the marketing, and these costs are different from the cost of sale because they cannot be linked directly to the production of good and service, right? So then we have is the depreciation. The depreciation is something that I take quite a amount of time yesterday to understand two verbs from English: wear and tear. Okay, so depreciation is also deducted from gross profit. Okay, so depreciation is also deducted from gross profit as the operating expense. Okay. But let me recap. So you have gross profit, you have gross revenue, some money that you don't expect to collect from sales, discounts, or merchandise returns. Once you subtract the return and allowance from the gross revenue, you reach the company net revenue. Uh, Most of the time, there's something in sales that represents different operating costs, but typically you will find right after that the cost of sales. So how much money a company uh, spends to produce the good and service. Uh, and then when you subtract the cost of revenue from the net company, it's important from the net revenue, you arrive at the gross profit, and it's considered gross because the number is not refined. Some certain expense has not been deducted from it yet. After the gross profit, then is what you have is the operating expense, and this expense goes toward to support the company operations, such as uh, salaries for administrative, uh, the cost of researching for new products, marketing, things that cannot be linked directly to the cost of sales because they cannot be associated directly to the production of goods and service. So that's why you have operating expense and cost of sales different. So after the operating expense, you have is the depreciation. And depreciation is also deducted from gross profit. Important. So mhm, okay. So operating expenses are deducted from gross profits as depreciation, which it takes in account the wear and tear of some assets, such as machinery, tools, and furniture, which are used over the long term. So tear is the use of an equipment in this context as a noun, right? Mm, as a noun. Uh, is the use of an equipment here as a noun. No, that's a verb as a noun. The damage from being turned. Okay, the act of weeping or grieving, broken to tears. A transparent drop of fluid hotter than fluid material matter, such as resin. Tears, a secretion of profuse tears that overflow the eyelids and dampen the face. Tear. So the damage from being turned is a damage. But again, as a verb, is the action of pulling two different parts or divide or disrupt. The tear is called tears easily. Mm-hmm. Tear the skin. To divide or disrupt, I pull the country force. Tear the skin. Tear a cover off. a box. Tear your thoughts away from the scene. Tear a hole in the wall. Rain tearing down the street. The bullet tore through his leg, mending a tear in her skirt. The train went by at a tear. She got paid and went on a tear. A run of unsuccessful success. The team wasn't a tear. A run of unusual success. The team wasn't a tear. Broken into tears. Mhm, mhm. But again, tear, and in this context, as a noun, is the damage from being turned, of the act of tearing something or pulling. And the other is the wear, is the damage that is the damage of use. Weaken to become weaker, damage, or thinner because of continuous use. Where to damage or become damaged through continuous use. It's a transitive and as a noun. The amount of use, exactly. As a noun, which is being used here, so the person you should take is the amount of use, okay? The preposition takes the amount of use or the wear, mhm, the wear and tear. The amount of use, the wear and tear. How badly, how damaged it is. Okay. On some assets. Okay. The act of tearing something to remove, to separate, to damage. Okay. As a noun, it is used like that. It means that. Okay. So depreciation is also deducted from gross profit as the operating expense, and depreciation takes in account the wear and tear, the amount of use, and the damage on some assets, such as machinery, tools, and furniture. Mm. Replace the tire after 2 years of normal wear. Mhm. To become annoying or tired. Weird thing. We're holding something. And we're holding. We're whole. Okay. Interesting. So depreciation is also deducted from gross profit. And depreciation takes in account the wear, the amount of use, and tear, how damaged, uh, and the damage on some assets, such as machinery, tools, and furniture. In my case, like in my laptop, it has some tear and wear, which are used over the long term. Companies spread the cost of these assets over the period they are used. This process of spreading these costs is called depreciation or amortization. The charge of using these assets during the period is a fraction of the original cost of the assets. Exactly. So company spread the cost of these assets over the period they are used. So which are used over the long term. Companies spread the cost of these assets over the periods they are used. This process of spreading this cost is called depreciation or amortization. So depreciation and amortization is a process of spreading the cost uh, or spread the cost of this asset over the period they use. Spread the cost of this asset over the period they use. When it means share or spread the cost, spread the cost of what? Of those assets? Spread the cost of these assets over the period they are used. So by spreading the cost, mm, chargeably. Yeah, chargeably. Mm, that's right. Here we are. Hey, hello. Okay. So this process of spreading the cost is called depreciation or amortization. The company spread the cost of this asset over a period of time. What does it mean? Spreading the cost. What does it mean? Come on, man. What does it mean? Companies spread the cost of the asset over a period of 5 years. They allocate the cost of an asset over its useful life, rather than recording the entire cost of expense. So it means that they allocate the cost of an asset over its useful life, rather than recording the entire cost of an expense in a period when they acquire. And they allocate the cost of an asset over its useful life rather than recording the entire cost of allocate. The precision is typically used for long-term assets such as building, machinery, and equipment, which are expected to provide value to the company for more than one accounting period. For more than one accounting period. Rather than recording the full cost of the asset in the year in its purchase, the company records a portion of the cost and expense in each accounting period over the asset's useful life. The useful life of an asset refers to the length of time that the asset is expected to provide value to the company. The useful life can be determined based on factors such as physical deterioration, change in technology, or change in the market condition. By spreading the cost of assets over their useful life, company can avoid large fluctuations in their earnings from period to period, which can improve their financial stability and makes it easy to compare their performance over time. Additionally, by recording the cost of assets as expense over time, company can more accurately reflect the true cost of generating revenue and can make better informed decisions about capital expenditure. Yeah, but it means that they allocate the cost of an asset over its useful life rather. Example of allocating allocating the cost of an asset over its useful life. Mm-hmm. So now they're asking that. Here are some examples of how companies might allocate the cost of an asset. over its useful life. Streamline depreciation. Here we come. This is when things start to be more interesting. It's like, okay, that, okay, how can I do that? Streamline depreciation. This is the most common method of depreciation and involves allocating the cost of an asset equally over its useful life. For example, if a company purchases a machine for $10,000 with a useful life of 3 years, 5 years, okay, it might, mm-hmm, it might, uh-huh, uh-huh, it might, what happened, ChatGPT? What happened, ChatGPT? Ooh, and break it. Interesting. Exactly. So examples of depreciation. Mm, Streamline depreciation. Cost of an asset minus salvage value. Year estimated useful. Streamline depreciation. Salvage value. When a profit and loss statement, while the book value and accumulated depreciation accounts pure. But how the fuck do they calculate that? Depreciation for building. Let's say a company purchased building. They cost of the building over its useful life by recording 25,000. Declining balance depreciation. Yeah, but how the fuck do they calculate that? It will be salvage. Salvage in technology. Accounting factor salvage technology. In technology. Depreciation of equipment. A company might purchase equipment such as material might allocate the cost of the equipment over its useful life by recording 10,000. As depreciation expands each year for the next 10 years. So for example, if I buy an equipment for this amount of money and I expect to last, okay, they spread that cost through an accounting. Okay, this, so they spread that cost into that. Mm, mm, okay, okay, interesting, interesting, very, very interesting. Mm-hmm. Mm-hmm. That makes sense. Okay, they spread the cost. So companies spread the cost of these assets over the period they're used. So for example, if an asset costs you, so if you buy a laptop and it costs you 1,300, okay, and you expect that to be used for 5 years, so you spread that you spread that cost. Um, Meaning that uh, you divide the total value of that equipment minus or by 5, and then you got the amount of money that it will depreciate yearly. That's all. Okay. 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 So they spread the cost of these assets over a period they are used. So this process of spreading the cost is called depreciation or amortization. They charge for using these assets during the period is a fraction of the original cost of assets. If I ask you again, interesting. Okay. So the charge of using this asset during the period is a fraction of the original cost of these assets. But again, depreciation that is also deducted from the gross profit as operating expense, it takes into account the wear and tear of some assets, right? It takes into account the wear and tear of some assets. Okay. It takes into account the wear and tear on some assets, such as machinery, equipment, tools, and furniture, which are used over the long term. So companies spread the cost of these assets over the period they are used. For example, if you purchase a laptop that costs you 1,300 and you expect to use that for 5 years, so you divide that number of years, or you divide the total value of the assets by the total year of use, and that is what you in that amount is what you're going to deduct every year. Okay. Okay, it makes sense. Okay, it makes sense. So this process of spreading the cost is called depreciation or amortization. So the charge for using these assets during the period is a fraction of the original cost of these assets. And after all, and the charge for using these assets during the period is a fraction of the original cost of the assets. After all operating expense are deducted from gross profit. Mhm. After all operating expense are deducted from gross profit, you arrive at operating profit before interest and income tax expense. Yeah, after all operating expenses are deducted from gross profit, you arrive at operating profit before interest and income tax. So after all operating expense are deducted from gross profits. So operating expense and depreciation that is deducted from gross profit, and it takes into account the wear, the amount of use and tear damage on some assets, such as machinery, tools, and furniture. So company spread the total cost of these assets over over the period they use, over their useful lifetime. Mhm. To allocate the cost of truck over its useful life, the company will record 10,000 as a depreciation expense each year. Then patent. The company obtained a patent for 200 and expected to be useful life for 10, 20 years. To allocate the cost of the patent over its useful life, the company will record 10,000 by 200 exactly. Again, this is linear depreciation because there are several ways of calculating that. Linear depreciation. Linear depreciation. Mhm. Exactly. So linear depreciation. So after all operating expense are deducted from the gross profits, and that includes the depreciation, which is deducted from gross profit, and it takes into account the wear, the amount of use, and tear damage on some assets such as equipment, tools, and furniture, which are used over the long term. So companies spread the total cost of these assets based on its useful life. For example, if you purchase a furniture, okay, for $500 and you expect to be used that for 10 years, okay, so you divide $500 per 500 divided by 10, and you get is 50. This is the amount that each year will be discount uh, for that asset, right? Again, this is to simplify is how company calculate uh, their depreciation or the loss of value in some assets, and that is the linear way of calculating that. This linear depreciation, okay, and during the period is a fraction of the linear cost of assets. So the process of spreading the cost is called depreciation or amortization. Mhm. After all operating expenses are deducted from gross profit, you arrive at the operating profit before interest and income tax. This is often called incomes from operations. Okay, so after operating expense has been deducted from gross profits, you arrive at operating profit before interest. Okay, so after all operating expenses are deducted from gross profit, you arrive at operating profits before income, before interest and income tax expense. And this is also called income from operations. So that'll be all for this video. So take care. Bye bye.